Hello and good evening, everyone. Welcome to the Business of Property. I'm your host, Cheryl Leong from Property Development Australia. I begin by acknowledging the traditional custodians of the land on which we meet and pay my respects to elders past and present. I extend that respect to Aboriginal and Torres Strait Islander people here today. At the Business of Property, we interview superstar guests in the property development space and share their expertise, their deals, their stories to help empower, build, and grow our community of property developers and investors. So, hello to Facebook land, LinkedIn, and YouTube. Anyone that's joining us today, give me a shout out. Preparing your property business for borrowing is what we're talking about today. And we've covered a lot in previous Business of Property episodes around how to fund your property development deal, how to get ready for construction finance and so on. But we're not really talking about that. We're talking about the long-term planning for your property business, whether your property business is in development or investment, how you can, say, for example, if you're growing portfolios of properties to hold, how does that impact your borrowing and your serviceability to continue to grow your portfolio of property assets? And hence, that's why we've got Aaron Wybrow. He's the founder and owner of Diagnostics and Finance. And his business basically provides expertise and advice on finance, and in particular for property investors. So today we're going to learn something that's a little bit different. And I said, we've talked about the development finance side of things, but we're going to be talking more so around the long-term financing and borrowing of property businesses. So without further ado, I'm going to invite Aaron down to the Business of Property dance floor. Aaron, please come on down.
How you going there, Cheryl? Good to be on the dance floor.
Yeah, that's it. We're going to have a little bit of disco today. Awesome. Thank you for joining us, Aaron. So we had a brief chat, and I mentioned to you that, in terms of topics, there's so many, we're noticing a lot more people purchasing properties that are high yielding, number one, because we've all noticed that the negative gearing story that was sold to us about 20 years ago is so we recognize that high cash flow properties are great, but also we're finding a lot more developers developing build to hold properties, right? Build to rent, like rooming houses, boarding houses, and so on. But the question that keeps coming up, Aaron, is what about serviceability? How do I keep doing this? How do I keep building my property businesses? And what's the impact on borrowing and serviceability? So maybe that's a good place to start without me going on too much.
The serviceability question is really the magical equations. And I think some people would put it in the box of magical equations that lenders have. And I talk to a lot of business owners that have such a varied borrowing power. They might get a small amount from one lender and a bigger amount from another one because of, we'll go with the magical calculations of income, liabilities you have, and other incomes that you have, the buffers that are put in, the ratios that are put in, and each lender will have a different take on different things because they all have to compete for a big piece of the pie. But a lot of we talk about the major banks have a big piece of the pie and the little ones have a little piece of the pie, and they all have to compete. And how do you compete with a big bank? You've got to compete on policy, and sometimes that enables you to borrow a bit more or a bit less depending on the situation. So serviceability, can you run out of serviceability? I'm going to say there's obvious a way to run out of serviceability, but I think if you do it in a planned way, I reckon you can get a continuous serviceability.
Tell us what the secret sauce is in what you mean by a planned way.
Okay, so I would put there's a couple of words here. Like most people will look at serviceability and go, can I run out? And that's like having an instant mentality, like an instant cup of coffee or something like that, where you want it all now. And sometimes when we have it all now, we want to buy 2, 3, 4, 5 properties at once, or hold that back in our stock that we've developed. If you need funding on that, that can, if you're going for lots at once, that can slow you down. But if you're going over a period of time or a period of or a journey, you've got the appreciation nature of property. You
Mm.
have the nature of rental incomes increasing, and that's quite a hot topic right now. I'm seeing a lot of renters
Mhm.
wanting
Mhm.
to control that or families or property businesses looking to increase their rent, or investors seeing that their agents are advising rent goes up. And the other one is you're having a super profitable business that you run,
Mm.
or income increases over a period of time will allow you to continually borrow. And the other one is the magic source is that you can actually pay down debt in a strategic way, which obviously, if you have less debt, you have more capacity to borrow.
Yeah. So you mentioned something about having a profitable business, right?
Mhm.
And so, say in terms of profitability and business and borrowing capacity, does that mean that you're looking at business loans, or are you talking about still residential loans? Can you sort of clarify that a little bit? Because I'm always thinking, if it's my profitable business, how am I going to then borrow money on a business loan to buy more property? Or are we talking about something else?
Yeah, I suppose you can split the income up. If you've got income for yourself as a person, income in your business, and
Mm,
income out of properties you may hold, and if you've structured into different entities, um, there are lenders that will look at every bit of your income as a group,
mm,
and that could have its benefits, where you can draw income from a whole range of sources. Or there are lenders that will look at the specific areas that you're trying to achieve the borrowing in, depending
mm,
on a few of their criteria and
mm.
all those conditions that we talk about when we go for loans. So that that's the aspect of putting all the income on the table to get your borrowing out. So it could be a
Mm.
combination or an area of one. Is that where you're
Okay.
going, Cheryl?
Yeah, 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 absolutely. Because when I think of a business, right, and we're talking about sort of property businesses, for example, and profitability from a property business might be might have developed something, have sold a whole lot, obviously got a whole lot of profit out of that. How will a lender look at that profitability and allow me to sort of go, how do they assess that from a serviceability point of view if
Yeah.
I'm looking to maybe purchase something to build to then hold on to, like an investment property or whichever?
I suppose that there's probably a two factor on that. If I take you back a second, if you're developing a bunch load of properties that you were selling off as individual titles and you wanted to hold on to some of those,
Mm,
a bit of preparation before you do the development to hold on to those, to understand that you can actually refinance the construction lending out to hold
mm,
it. And
mm,
if it's in the commercial land, it has a little bit more flexibility around um, the possibility of using cost ratios, or looking at full serviceability to hold some properties that you're developing at the end to get out of that construction finance. When you're sold the whole lot and you take all the money out, and
mm.
wherever you're going to go from there, and depending on other incomes or how you're going to recognize your income, that will enable you to borrow in either another entity or your own name, depending on what your goal is.
Yeah, okay. And what do you mean by cost ratios in layman's language,
In
layperson?
layman's language. So it's as you've said before, you've gone through some of the construction finance and looking at whether you're building to sell or building
Mm,
to hold, or hold some. And there's all the buffers and all those nice little things, soft cost contingency funds, all those things that you've probably gone through in many different episodes. But you can look at the development that you're holding on to, and look at what the income is and what it's going to cost to hold in all the metrics that are judged as an expense for that particular site. And you can look
mm.
to fund that site on its own merits without looking too deeper.
Yeah, okay, absolutely. So, in if we're looking at then purchasing, um, for example, I'm seeing lots of rooming houses, boarding houses, so on. on the market for sale. Those sorts of properties, would you be looking at commercial lending in those sorts of direct purchases? And then that's number one. And then we'll talk around, I guess, then how we keep continuing to purchase those sorts of properties.
Yeah. So rooming houses in general terms are in the commercial lending space. There might be some exceptions to that, but in the main, where I've done the lending on rooming houses, it's been in the commercial space, which has given us a little bit more flexibility because there's two different regulations in lending, but the commercial has a little bit more flexibility than does the standard residential lending, and other calculations that they use. So commercial is in the main where I've gone for rooming
Yeah.
houses.
And generally from how do they work out how much they can lend, like the lender can lend you? Because is it based on a cap rate, but similar to how you would commercial if you were doing industrial or warehousing?
Yeah, the commercial lending products, they don't really change from their specifications. It's just a business loan that you've bought. You could have bought a farm, you could have bought a office block, a warehouse. The name of the loan usually remains about the same. And what varies across the lenders is some of the nitty gritty bits. So in the main, we find in 65% lenders usually are depending on the type of rooming house. And you might have some lenders that go lower on that from the lending point of view, and some that may even sneak up a bit higher to the 65-70% mark. It really depends on location. Lending's always a bit of a match between who's borrowing the money and what does the asset look like, how does it value, in all the factors, whether you're still having it in GST registered land or not, and that all comes onto the table before they can get the right LVR, in the more technical term, the loan to value ratio.
Have you found that any of these sorts of rooming houses, or HMOs, whichever, that sort of look like normal houses, right? Have you found any of them sort of fall within that residential space, but still get good valuations from a commercial valuation? The best of both worlds. Is that sort of utopia? Does that exist?
You touch on an interesting topic where I've had clients come to me and say, I've got a pizza cutter house. They've got the nice $500,000 house, but they've got like 4 rooms and they've got 4 tenants.
Yes.
The thing with that one is boarding houses and stuff in the residential land, depending on how it's always a little bit of a bone of contention when you get the valuer in there, and most of the lenders in the standard resi land, I'm finding, don't like rooming houses or boarding houses, and I suppose there's a couple of factors, like if you're developing or taking an existing property and renting out each room space. We find a lot of residential lending where it's family. If you're taking board income or other lease type income from family or close people, but it's a very grey area where we're trying to get into residential lending space. And also, is it council approved? And I suppose you've been involved in rooming houses and those sorts of things where you get the council improvements. Is it fire safety, all that sort of stuff? And the lender doesn't want to get tied up into lending money based on a higher rental income and then finding that it's not council approved. Lenders are very conservative.
Yeah. Let's turn the topic around ownership and the type of entity that you own the property, and whether it's in your personal name or in a trust structure or a company, to be able to maximize. Again, I'm going to go back to borrowing and serviceability. Is one better than the other, or it just comes down to, I know you're going to say it comes down to individual circumstances, but typically is one better than the other?
This is a very common question about personal land versus putting in a trust or a holding trust or something
Mm,
that is
mm,
passive income. And there's also even this topic about trading entities as well, which is
mm,
another higher level conversation about holding properties. Personal name has your own personal income in it. And if you're lending in your personal name, any losses that are associated with the property, typically we're looking at properties that are high yielding. If they're newer properties, they have that magic called depreciation in there that typically will give you that offset onto your income. Whereas holding property in a trust, if you run it at a loss in the trust, the losses can't be attributed to anything. So that's number one. So that would then come into your question about circumstances. So, and your own goal, like a higher income person in their personal world may want some more deductions versus someone not on such a really, really high income. Putting properties into a trust, on the other hand, will allow you to do a whole range of different things. Like, for example, as you build up you might have a roomy house, you might have a standard residential house, and you've got a conglomerate of rental incomes now. You have the ability to put an ABN, not that you don't have that
mm,
ability on your own person, but
mm.
when you structure it into a trust, you have the ability for ABN, GST, and you can probably take a ticket to a game that you can play in commercial, larger commercial, and other choices that you might have compared to putting it all in your personal name, because I'm not the accountant, but there are
Mm.
some tax bans that you probably want to avoid. Well, I personally
Yeah.
want to avoid as well.
Yeah, yeah. So obviously speak to your accountant about your personal circumstances regarding which are the best sorts of entities. From what we're talking in terms of a borrowing capacity perspective, what are the things to consider? Obviously, as much as you can leverage um, the tax benefits in each of those sorts of entities. Again, speak to your accountant about that. Um, again, in terms of then creating some sort of a plan, because at the very start we talked about having a plan and being um, a bit strategic in terms of, instead of it being instant coffee, or was it we talked about drip coffee? There's a reference to coffee.
I said instant coffee. It could be like I want to buy the TV now instead of waiting for it, or
Yes.
anything like
Yes.
that. Yeah.
Yeah, yeah. And so, can you give us an example of how we can leverage this almost bottomless pit of serviceability if we're willing to be more patient and um and, and strategic about how we're doing it?
Yeah. So there's always, I'll come back to the serviceability calculator. So if I can put more income on the calculator, I get more serviceability.
Mm,
If I can put more rental income on the calculator, I get more serviceability. And there's twofold with the rental income. A lot of lenders will shade the income of the rent,
mm,
and that shading, if you can make that shading less impactful, like having a 2.5% rental yield property versus a 6.5% rental yield property, the 20% is going to
mm,
hurt or not hurt as much. So um, that those two factors I can put on the calculator. I can put income in, I can put rent in. The other factor that I can put in is the lending, and then how much lending is it, what interest rate is it at, and how
mm.
much serviceability buffer that they're going to put on. So in personal lending land or standard residential land, they're putting a 3% serviceability assessment on top of what you actually pay.
Okay.
Commercial can have different calculations on what coverage ratio, what industry type it is that you're purchasing in as well. And that all comes into it. And then the next step is that what does it cost you to hold the property? So you might get a lender that's offering a great rate, but they're asking a bit more scrutiny of what are the fees associated in the rental property itself to take that into account and reduce lending, and some are not. So the basics around how do you access a bottomless pit of serviceability is that you go down the path that you can go out and buy lots of properties all at once, or you can buy one and then buy another,
Mm,
and look at the
mm,
appreciating nature of what's your income, how's the rental income changing, and
mm,
how's the lending changing over time, which will greatly affect what else you can buy and borrow.
mm. So if I'm not wrong, what we're saying is, leveraging if there's capital growth, the equity, the LVR on that
Yep.
property, and also the fact that if you've got a high yielding property, which is what we want, because
Yep.
there's the lenders are taking a discount off what your the yield is, plus increase, adding that 3% on top of, say, if you're paying 3%. So they're factoring 6%, for example.
Absolutely.
Yeah,
The,
yeah.
the real example on that, I'll take a really basic one, not necessarily in the property development land, but into a couple that are trying to start out their
Mm,
in property
mm,
investment journey. So they have their own home. Their own home is paid down to a small amount of money. Their son has just left home to go to university.
mm,
And rents are climbing at the moment. There is a common trend that I'm hearing. Investors are very happy with rents going up, and
mm.
renters are not very happy with rents going up.
Rent's going up. Yep.
Yeah. So the parents in this case wanted to lock down the property, the rental price, to help their son get through university. So they're going to start investing down that path, and those
Mm,
are social plays. The numbers and everything haven't really come onto the scene so much as I'm going to help family here. What they do want to do is not stop at that property to help their son out. They want to then say, okay, well, if that property is going to cost me to help my son out, how about we get a property to help pay for that?
mm.
And that's where we've been talking tonight around the high yielding properties. How can we now get a property to offset the
Yeah,
cost of that property,
yeah.
and also maintain that serviceability as well for lending? Um,
Mm,
and that's how we can play, not only starting a property portfolio in a social sense of helping children out, but we could reverse that, and maybe they didn't have to help their children out, and now they want to invest. Maybe
mm,
it's time to go a little harder on a higher yielding property, because
mm,
their employees, they're on a fixed income, and the main variability they have is what the rental yield is.
mm,
Um, on the other side of the coin, you might have a person that's earning an exuberant income, and that brings a whole different strategy to rental yield onto the table.
mm, mm. Let's go back to strategy and around how to pay off home loans quicker, right?
Mm,
We've talked around, the idea of building portfolios of high yielding properties and so on and so forth. The question that I often hear people say is, do I just pay down that loan for that property as quickly as possible? Or how can I then or pay off my home loan as quickly as possible? Is there again a better strategy to do all that?
So this is another question, and I get similar questions as well, and you can get different layers. Like, if you've gone out and got all your borrowings at principal and interest, or
Mm,
have you got it at interest only? Have you got a combination of the two? What type of what amount of lending do you have? You might have 100,000 on one property and 900,000 on another property. And which properties you want to buy down. So you can take a numerical sequence, and if anyone's seen some of the snowball your debt from the David Ramsey stuff, where you go after the smallest debt, and once you paid off the smallest debt, you think, really, I'm really good. I'm going down the right path. Or do you flick the gears and think, okay, what type of asset do I have? Which one am I going to hold on for a long period of time?
mm,
And you might want to hold on to the one that's got a 100 grand borrowing on it for a longer period of time. So you might change your tactic to pay down the one that may be a little bit more variable or market volatility. So it has a numerical approach to pay down debt, and it also has what's your strategy around which properties you want to hold on to. If you still have owner occupied debt, um,
mm.
that's obviously going to be the first target of anyone that we can
Yeah.
get out there. And there are a few different ways that you can recycle that and keep some of that lower interest rate that owner occupied has as well. So making sure your non-deductible debt is not there, or any other debt that's outside real estate will be my first target. But in property, it's either numerical or it's the type of asset you want to hold on to for the long term.
Yeah. And so if you're paying down your home loan, because that's non-deductible debt, right? Rich dad,
Yep.
poor dad calls that bad debt. So if I'm not wrong, if I remember my rich dad, poor dad. And you're paying that down. However, if you've got equity from that and you pull that out, does that then become deductible debt?
It can, as long as you're using the equity to invest.
Yes.
So paying, if you have $100,000 home loan and you've got $100,000 and you want to use it's a common question I get is, I've got $100,000 cash, but I've still got a home loan of $100,000. How do I use that $100,000 and still make it deductible instead of putting the $100,000 down on a house and still having your owner occupied mortgage? So there's this thing called debt recycling, where you can actually pay down the $100,000 down to a nominal level, and then you can use the bank's product called redraw and redraw it out for the purposes of buying an investment property. The other factor of equity is that you might owe $100,000, but your property is worth $1 million. Now, theoretically, in low-cost borrowing, in residential, you could pull out up to the maximum loan-to-value ratio without having the large costs of fees. So if it was residential at $1 million, you'd be able to pull out another $700,000 without it totally affecting the cost of your borrowing. And then you could divide that. You can put it in its own BSB and account number on your current home, and you could divide that up into different deposits for you to go out and have a fun time going out shopping or building
Buying
or
assets.
developing. Absolute buying assets, not shopping in the way of assets, property business.
Liabilities, yes.
Property business stuff.
I've been teaching my children about assets and liabilities. And I'm like, Minecraft, is it an asset or is it a liability? And they're like, we're building houses in it, Mum. It's an asset.
It's I had a colleague of mine introduce me to, maybe there's ways to buy stuff in the metaverse, but I haven't got my head around that just yet. And maybe that's got a Minecraft feel there.
I think so. Yeah, absolutely. My children are spending my money on Minecraft. I'm like, that's the way of the future. They're going to be spending big money on stuff there. We can see it happening.
Yeah.
So on to interest rates. Right. I'm sure you're getting lots of these questions now. Everyone's going, interest rates are on the rise. How do we go about managing all of this?
Yeah, so it is a very hot topic at the moment, especially around the fixed rates. In our personal life, on our own place, on investment properties, interest only versus principal interest usually has a different flavor of rate. One's higher than the other. I'm finding, like just as of Friday, across National Australia Bank, they put their fixed rates up by 0.6%, just like that. No warning, no nothing. And I remember a conversation that we had. We're going to go for a fixed rate. We're going for a rate lock, which is a fancy word that says I'm going to lock it in, pay a fee to the bank to lock in the rate now at the time of application versus when it becomes effective. I'll pop back to that in a second. And in the matter of the phone call, it changed. So customers still keen to rate lock and still keen to take the rate, but it is a changing market in the fixed rate. So rate lock is a fancy word. If you're looking at fixed rates now, it's not everyone's cup of tea, and a lot of the lending that I do is still variable because of the flexibility of the nature, and in property development business, property business, there's still going to need to be some flexibility about what assets you might want to offload, and having a break cost is probably not advantageous for anyone if you're looking at that. The other thing I'm finding with rate lock versus staying variable is I have a bunch load of investors that I'm working with at the moment that have a low loan amount on their owner occupied with oodles of equity, and they are well and truly overpaying their mortgage to the rate that I effectively went through the numbers with them, and they're paying about $270 more a month than they need to, which means that they're paying the equivalent minimum repayment of 16%, and they're paying 2.99 at the moment. So they've got oodles of room there, but they also could come out shopping for assets easily there, even if the rate goes up, as long as it's the right asset that they want to add to their portfolio. So there's a subset of borrowers that are owing just a little amount of money that are getting ready to go shopping in an upwards trend of the interest rates. And there's a lot of people that have a lot of debt owner occupied wise that are wanting to fix their rates at the moment. Do I think fixed rates and variable rates are going to equal each other? I think the writing's on the wall that there is going to be rate rises from the variable components. I can say personally from my experience, I refinanced my home loan recently. I applied and it was going to be one rate, and I got a variable rate that was 0.1 higher. No advertisement, no media notification, no RBA change, no nothing. So I think we're going to enter this period with interest rates that the banks will just do what they do. We're seeing it with fixed rates at 0.4, 0.6, even one rate went up 0.8%, and there's no warning. And if you're going to fix, it's probably worth considering the rate locks and doing a cost analysis on that. Property investors are really good at doing their numbers, so please just do the cost analysis on that. But variable rates are very strong at the moment. I've had lenders call me up and say that they're really discounting behind the scenes very strongly on some of the variable rates at the moment. So there's an argument to say move your variable rate down as low as you can so you can absorb rate increases. And then there's an argument to go, okay, well, my budget really needs something at the moment to lock this in and make it stable.
Yeah. Well, Aaron, you've definitely covered quite a lot of really meaty stuff around, again, the considerations, particularly, a lot of people in our community, they are property developers. Obviously, they're property investors as well, but and a lot of people own properties. We've had this huge amount of capital growth in our properties over the last few years. The reason we want to have this conversation is going, well, let's see how much equity you can leverage to then allow you to continually purchase properties, but it's about buying the right types of properties, also structuring your loans to allow you to keep leveraging serviceability, but also consider if you are developing, like, do you really need to be selling all your stock as well? Or is there a smarter way to do things as well that you're holding on to some level of stock?
Yeah, exactly right. One of the things is as if you're a property developer or even a business owner, we're really good at what we do, and we're really good at making the money and then taking the money and putting it into another project. And we might do a few projects down the line, and we've got all this money that we're able to dump into the next project and the next project and the next project, and then we turn around and we go, do we have our own house? Do we have some investment properties? Do we have this? What have we collected along the way? We talked about the instant coffee versus the time in the journey. This is a time in the journey one. Like, is there a way that some of the profitability could turn into you holding stock? Even if it's just one, even if it's half a dozen, whatever the affordability could say. Did you do a cost analysis on holding instead of selling? Holding some or holding the lot? Has those numbers come across your path? It might not be for the first development that you do, but always think we're really good at what we do in business, but have we looked at our wealth creation goals as well, and how does that fit into the leverage of the bank's money to hold these for more than the construction time?
Yeah. I like that. If there's one thing that you take away from today's call, episode, is that question around what is my wealth creation strategy around, particularly if it's development or investment. How am I continuing to build that wealth through property and whatever assets it is that you want to purchase? But it is a property show, so
Yeah, the advantage that you might have as a property developer is you might be able to build 10. I'll take a number 10. You might be able
yeah.
to build 10, but you only need to sell 5 or 6 to get your money
Mm.
back, to pay out the things, get the right profitability. So you're now sitting on this nice decision that there's a little bit of leverage you can shove in there, but it's not going to
Mm.
cost your business either. So there's a cost,
Mm.
there's an advantage there, or you can sell it for profit. It's a question that's could sit on any developer's mind.
And then you've got to consider the GST components and stuff like that, but speak to your accountant about it.
Accountant. Yeah.
But the whole point is that if you're able to then have properties that you're holding at low or no sort of need for leverage, and you've got all this income from there, imagine how much of that additional rental yield and income then goes towards either paying your home loan off or just continually allowing you that unlimited, well of serviceability and borrowing capacity.
Absolutely.
And that's the goal, isn't it?
It is. It's about having that choice to do more, or to live where you want to, or depending on the age, on an age spectrum, if you're coming closer to retirement, it can be good to have less debt than when you're younger, where you might want to build up a bit more of a portfolio to do that. So lots of circumstances to overlay in when you're looking to borrow money.
Absolutely. Well, if anyone that's listening today, if you're watching live or the replay, and this, the conversation around building your property business and borrowing and building your long-term wealth, if you sort of go, I've got all this equity in my property, I don't know what to do or how I'm going to keep going. Have a chat to Aaron. The whole point is you can see it's not a cookie cutter. It's not necessarily, there we go, customer care at d&f.com.au. Speak to someone like Aaron around how you can be more strategic with your lending. And when we say the word strategic, it's not just around buying one house, doing the whole stock standard thing. It's really a long-term plan towards creating wealth, whether it's through development or investment or a combination of both. Having the right team, like your accountant, your mortgage broker, is critical to you getting to that part where you need to be. So
important to have that team.
Absolutely. So thank you, Aaron. And if anyone wants to get in contact with you apart from the email, where else can they find out more about what it is that you do?
Yeah, so you can go to my website, www.dandf.com.au, or you can call my office and we can schedule time, and that's 0291 884488.
Fantastic. 88 is a very auspicious Chinese number, so good on you. Oh, lots of eights. There we are.
Yes.
Very auspicious. Fabulous. Thank you, Aaron. That's fantastic. We covered a lot of really, really interesting topics here that we haven't really spoken about before at the business of property. So I'm very glad that for you to share and spread your knowledge. So thank you. Thank you
pleasure.
very much. And we'll see you again. So thank you, everyone, for joining us at The Business of Property. Make sure you visit and subscribe to our YouTube channel, The Business of Property, where you can find all our past episodes. And if you found value in today's show and want more, hit the like button and get notified when a new episode pops up. So till next time, keep well, and I'll see you again. Take care. Bye-bye.